Well, hello, everyone. Hey, everyone. Welcome back to Finance Friday on the ARC UK YouTube network. I'm Hard Money Jim, and as always, I'm interested in money creation and its consequences. And I'm speaking from beautiful Jackson Hole, Wyoming, where both the tourists and the wildlife have returned for the summer season. So let me share my screen, and we'll get started. So now I'll get this slideshow on. Here we go. Like I said, the tourists and the wildlife have returned for the summer season, and here they are together. As you can see from this recent photo here, the tourists are not always the rational animals. They really need to remember that these are not, guys like this bison here are not barnyard creatures, and they can be really dangerous if you get too close. But you don't have to get close because it's really fun to watch them from a safe distance in their natural habitat. So I encourage you to come to Yellowstone. To come to Yellowstone. And when you do, please don't do this. Okay, today we're going to talk about a different kind of irrationality, an increasingly popular myth about inflation that I'm seeing increasingly in the financial press. And I'm speaking of this kind of shop-worn recycled claim that business people cause inflation by charging exorbitant profits. And we're going to slay that dragon today. And after we take care of that important chore, time permitting, I'll comment on a couple of other newsworthy topics that I'm sure you're aware of, namely the debt ceiling debate, which has dominated the mainstream news, and then the stock market hype surrounding the so-called artificial intelligence stocks, which has dominated the financial news. Now, I hope we get to all that today. If we don't, it'll be included in a transcript that I send out later. So anyway, we have three parts today. Part one, the main event, is on the increasingly popular myth that inflation is caused by price gouging business profiteers. And then in part two, we'll get to some comments on the meaning and importance of this debate in the US Congress over the debt ceiling. And finally, part three, some comments on the extraordinary surge in the prices of some stocks that are related to the growing AI technology. Okay, so without further ado, let's get started. Let's dive into part one with a question. Can business decision makers cause higher inflation simply by charging higher prices? And here is a typical example of the financial news stories that I am seeing today. There's a growing school of thought, and it's not new. It's mainly an old idea being recycled for the current inflationary economic cycle, claiming that businessmen can raise prices arbitrarily, and because they can do this, that this recent bout of consumer price inflation we've had is caused, at least in part, by their corporate greed. The purveyors of this concept have adopted a ridiculous portmanteau. You know that word, portmanteau? It's a made-up word that's supposed to combine two meanings into one word, like stagflation or Brexit. So the proposition behind so-called greedflation is that businesses can take advantage of their monopolistic position to raise prices, and they can hide those price increases in a sea of other rising prices, and they can do this simply because they want to be greedy. So this recent article here from Axios is a case in point. The New York Times is also behind this idea. I don't show the Times headline because I don't have a subscription. And here's another example from a mainstream investment publication called Seeking Alpha. And in a modern, and I've seen it elsewhere in what I call a modern example of the capitalists trying to commit public suicide by catering to their enemies. I even see this from Wall Street firms that are, jumping on that bandwagon, jumping in that bandwagon. So to unpack this thesis, let's start with some data. This is the aggregate after-tax profit data from the USA, courtesy of the Bureau of Economic Affairs, and as reported by the Fed. Clearly, you can see from this graph, there's been a major upward thrust in profits, especially on the far right there, since the pointer here, on the far right, since the 2020 pandemic and then stimulus. That coincides with the onset of significant consumer price price increases, which came about right after the great pandemic monetary stimulus. Now, next here we have, this is a long-term chart of nominal gross domestic income in the USA. Gross domestic income is equivalent roughly to gross domestic product, and it's also a pretty good proxy for total business sales. So the direction here is also clearly upward with minor downturns that you see here and here and here at the time of recessions. Otherwise, other than those minor downturns, it's a steady progress upward. Now, combining those two data sets, dividing profits by sales, we get profits as a percentage of sales, which is also known as profit margin. This is after-tax profit margin. And as you can see, as this profit margin oscillates, but it oscillates over time, but it's pretty stable. It rarely goes before 4% here, and rarely above 8%, which it did just recently. Most of the time, it fluctuates around 6%. And that makes sense when you consider that businesses compete for profits, that they price their goods high enough to make a profit, but low enough to maintain market share. And profits ebb and flow as businesses, invest and sell their goods. So this is what we'd expect to see in a mildly inflationary environment where sales are always growing due to more money in the system. Profits grow with the sales, but profit margins stay fairly steady. Now, here's a close-up of that first after-tax profits chart. This time, it only goes back to 2010. To a simple-minded capitalist, this looks great for business, right? Surging profits right here since 2020, that must be good for business. All right, now let's take a look at this same chart alongside a chart of broad money supply, also called M2. Money supply M2 is on the red on the left. It's the red line. And profit after tax is blue. That's red on the right-hand scale. That's the blue line. Let's note several things here. First, profits were fairly level for years until the pandemic, and then profits surged. And profits surged right along with the pandemic monetary stimulus. Right after the short, this very short recession associated with the onset of the pandemic. Now, both money supply and profits had an unprecedented rate of increase in 2022. And profits skyrocketed right alongside skyrocketing money supply. This is an all-time high for both profits and money supply, and an all-time record increase in both profits and money supply over the previous year or two. So M2 and profits seem to be closely correlated, both rise and fall at about the same time, because as you can see, profits tailed off here somewhat, as money supply has tailed off a little bit during quantitative tightening. So, this decline in profit is from 3.2 trillion to about 2.7 trillion, and it's up from a previous number more like 1.6 trillion back here in 2016. So just less than in about 8 years, corporate profits have doubled. Okay, these two data sets show a pretty strong correlation. And we can reasonably suspect that they're related, but how? Now, I contend that the surge in money supply, the red line, is the reason, it's the cause for the surge in profits. And I now want to illustrate why. So we want to know what caused this surge in profits, this big surge in profits here. Was it corporate greed, or was it something else? Is this surge in profits beneficial to business, as it appears to be, or is it not? Okay. One of the leading outcomes of inflation, which of course I define as an excessive increase in the money supply, is rising prices. So let's now look at an individual's firm profits and see what happens to profits first under the conditions of stable prices and then under the conditions of rising prices. So as we all know, the profit of a business is just the difference between sales and costs. Sales minus costs during a designated period. Here's a typical presentation of a company that makes a modest profit. Imagine a simple, steady business that has an annual cost of 100, makes annual sales of 110. The profit before tax is 10, or 110 minus 100. Profit before tax is 10. The tax on the profit at 20% is 2, leaving a profit after tax of 8. So this is a steady state business under stable prices. So what do most people think happens to sales, costs, and profits under inflation? Now you can do some math in your head, and intuitively you might think that if prices are rising throughout the economy, then the effect on sales and profits should be the same. So you might think, okay, if sales go up 10% from 110 to say 121, and costs go up 10% from 100 to 110, then profits before tax are 121 minus 110, or 11. And 11 in profits is 10% higher than these steady state profits shown here. So it appears that sales, costs, profits, taxes all increase uniformly at 10% a year. So I want to show why this intuitive kind of thinking is not only simplistic, but it's actually dead wrong. And it's wrong because of two factors. First, because of the time that elapses between when the costs of production are incurred and when a product is sold. And second, because of the effect of income taxes on pre-tax nominal profits. So let's consider the time factor first. We have to remember that there's a time lag, sometimes a very significant lag, between the time when most business costs are incurred, that is when the cash is actually paid out for materials or labor or other investments, and the time when the product is sold. Now, people often forget this, perhaps because when we look at a traditional profit and loss sheet like this, sales is always at the top, followed by costs or deductions against sales to compute profits. And this standard gives the impression that sales and costs are incurred at the same time, but nothing could be further from the truth. If you think how far in advance materials and labor have to be sourced and assembled and paid for before any product can be manufactured or marketed, you begin to think that almost all costs, you see that all costs listed on a profit and loss statement, almost all, were made well before any revenue was brought in from a sale. Now, this is actually one very important function of a capitalist, to finance investment over time, to provide the capital, the materials, labor, the land, and so on, to put these factors of production to work before anything is sold. All economic production occurs over time, and nearly all expenses in a profit and loss statement are paid for well in advance of sales. The only exceptions I can think of are expenses like royalties and commissions, which are netted out of sales at the point of sale. Okay, but all operational costs are in advance of revenue. Okay, now here's a simple model, financial model of a simple business. Now it's like a profit and loss statement, except it lists the expenditures and the sales in the order they occur. So you can see that the business starts at year 0 here with an outlay of cash of 100, followed in year 1 by sales revenues of 110. Notice that I drew a little diagonal arrow here from the costs in the previous year to the sales in the subsequent year. And that is to draw your attention to the fact that costs paid, it's the costs that were paid in a previous period that are subtracted from revenues in the current period in order to show the profits of the current period. That's how it happens in the real world, and it's crucial to keep this in mind. So this simple model here assumes stable prices or no inflation. So the owner lays out 100 in costs at the beginning of the year. At the end of the year, he sells his product for 110. This leaves him a profit before tax of 10, on which he pays 20% income tax of 2, leaving 108 in total funds to fund both next year's business expenses and to pay himself a dividend for his net profit of 8 in order to feed his family and pay for his living expenses. So under stable prices, all else equal, this could go on for years and years. Okay, see if I've got everybody here. Okay, now let's see how things look when prices are rising at 10% a year. So we start with the same outlay of costs, 100, but now between the time when the costs were put out there and the time when the product was sold, prices went up 10%. So what would have sold for 110 now sells for 121. Okay. So, by the way, for simplicity, we're assuming that all costs on all sides go up 10% a year. Okay. Because that just takes the focus off timing differences and focuses only what I want to show you today. So what we see is that profits rise substantially here. Profits before tax are 21. And they rise substantially because the cost of production was recorded before all prices started to rise. So profits after tax also more than doubled, going from 8, they were 8 under steady prices, now they're over 16. Taxes more than doubled as well, going from 2 to 4.2. So far, this looks like both the businessmen and the government made out pretty well. Maybe inflation's a good thing for business. Well, not so fast. Let's keep going. At the end of year 1, look what it costs. Look at the replacement cost. Look what it costs the businessman, the business owner, to stay in business and continue living. Prices rose 10% during the production period. So the owner has to replace his inventory at 110, not 100. But he only has a total of 116.8, his total sales revenue minus taxes, to pay for his new, more expensive inventory. After investing 110 now to pay for new inventory, he only has 6.8 left to live on. Less than he had under stable prices. Even worse, the dividend dollars he does get to keep now by 10% less than they used to. So just to keep up his standard of living, he needs a dividend that's 10% higher than what he was getting before inflation took off. But in fact, his dividend is now much lower. And so under these conditions, when profits more than double, the business owner's standard of living actually declines by, according to my calculations, about 23%. Now this process of wealth destruction, despite higher profits, continues year after year as long as prices keep rising year after year. The businessman's profits go up nominally, and after the first year, it's true that his dividends start going up nominally. But his dividends are always well less than what he needs to maintain his original pre-inflation standard of living. So he has to delve into his dividend, that is, reduce his standard of living just to invest enough money to stay in business. So what is this business person supposed to do? If he or she can successfully anticipate their cost increases, and if their customers will bear those increased costs, perhaps he can raise his prices more than 10%. I did a quick calculation on that, and in this case, it appears that the owner could maintain a real dividend, meaning a dividend high enough to make up for inflation, if he increased his prices by 12%, while his costs went up at only 10%. But of course, he does not know, and he cannot know in advance how much costs are going to rise. And he cannot even know if his customers are going to pay the increased sales price that he needs to charge. Remember, we're looking at these business results after the increase in prices occurred, but no one, not the Fed, not the business owner, not his accountant, not the customer, nobody can know what those increases are going to be in advance. So everyone's flying blind, guessing, and taking risks of miscalculation under conditions that they've really never faced before. So this is why I say that a major effect of an undue increase in the money supply, which, as you know, is my preferred definition of inflation, is the difficulty or near impossibility of sound economic planning, of making reasonable economic calculations. This difficulty in planning applies equally to producers as well as consumers. All the market participants are confused, and virtually everyone is surprised by the outcome. This uncertainty leads to major changes in economic behavior by both businesses and customers. And these changes in the behavior then themselves add further uncertainty to business conditions. Now, neither business person nor customer knows in advance how much to charge or how much to pay. It seems with these contrived numbers easy, to see how the businessman is getting screwed here. But in real life, these price changes are not easy to identify, and it's actually hard to tell that the business person is getting screwed. For example, the businessman might not even first realize that he's in danger of going out of business unless he raises prices substantially. And this lack of knowledge might actually be lethal to his business, and he doesn't even know. Now, this example also illustrates the effects of financial repression. Notice how taxes almost double the first year and then continue rising at 10%. That's a very significant increase in real revenue for the government, even as the business owner's real profit is declining. And note, and this is important, that under inflation, the business owner is losing more real wealth to the government than ever before. So please recall our discussions of financial repression. One important element of repression is that the government needs inflating prices to collect more taxes in exactly the manner that's shown by this example. In collecting these taxes, the government leaves the business owner poorer than he was before the inflation began. So this is a concrete example of how financial repression robs the real wealth of businessmen and savers and wage earners and transfers it to the government so they can increase spending or pay down their debts with inflated money. So I hope you see here how a heavy spending government benefits at the expense of its citizens under inflation. It's the classic way to raise taxes and confiscate real wealth without people realizing. This is the mechanism by which governments inflate their way out of debt. So one lesson here is that inflation, that is money creation, can have effects that look good on the surface, like increased profits. At first, it looks good, but don't confuse increased profits with an increase in actual wealth or with real economic progress. On the contrary, I think this example explains how the surge in corporate profits was caused by the pandemic-related surge in money supply. And it's the most blatant act of inflation in my lifetime. Okay, let's see what I got here. Okay, Edmund says, jobs report shocks economists. You know what? I'll make a quick comment on that before I get back to greedflation. The jobs reports have exceeded Wall Street estimates and economist estimates now. Well, are you ready? 14 months in a row. I would say they're missing something if they get it wrong 14 months in a row, wouldn't you? Okay, let's go back here now, back to greedflation. Now, there's no lack of anti-business pundits and economists who are ready to reverse cause and effect and blame businessmen for inflation. Some of these studies even apply, try to appear respectable. Here's a recent study by the Kansas City Federal Reserve Bank, which concluded that corporate profits, quote, account for a large percentage of the increase in CPI. So I can imagine that in the eyes of the PhDs of the Kansas City Fed, the business owner in our example is guilty of price gouging his way to inflated profits, even as his standard of living declines by 23%. So this twisted reasoning claims that businesses can raise their prices, raising their profits, and that this is the cause of inflation. But their claim is exactly the opposite of reality. Raising prices to get higher nominal profits is not the cause of higher prices. The actual mechanism is money creation inflates demand, thereby inflating prices and inflating nominal profits. So higher profits are the result of inflation, not the cause of inflation. So in my view, this strange line of thinking from mainstream economists stems from their assumption that businesses can raise prices arbitrarily, at will. But businesses have to respond to market conditions. They're not, despite what Elizabeth Warren and Joe Biden say, in a position to just jack up prices because they want to. And I am sorry to say that at least one alleged defender of capitalism, the Wall Street Journal, is not getting it right. Here's a frankly appalling article from May 25th. It's reminiscent to me of the Gordon Gekko "Greed is Good" speech from the movie Wall Street, if you've seen that. In the author's view, raising prices is just an inherently bad thing to start with, but it's a necessary thing that can be, quote, excused, that is morally justified. And his self-contradictory justification seems to be that despite the inherent immorality of price gouging, profits serve a positive social function, so they should be permitted. The implicit assumptions are not only that business people are in a position to raise prices at will, but that under normal conditions, they should minimize their profits for the good of the rest of us, except when higher profits are justified by the greater good. Of course, as our example shows, nothing could be further from the truth than that narrative. Now, on a slightly brighter note, there are a few better writers tackling this subject. In this article from last Wednesday, the Mises Institute got it partly right, but even they did not identify the crucial point that production occurs over time. The article also neglected tax issues. So, 2 cheers or maybe 1.5 cheers for Mises.org in this case. So just to wrap up this first section, my final message on this topic is, as you read popular economic journalism, read it carefully and critically, no matter what the source is. Stick to the facts and logic, and you'll often come up with a much different answer than the sources that you thought were, sympathetic to free markets. And if you have a personal interest, you would be doing yourself a favor and doing many other people a favor, a great service actually, by studying sound economics and then becoming an economist or a financial journalist and reporting the facts fairly. Okay, let's see what we got here from. Would Midas Mulligan, Edmund, you're full of these great comments. Would Midas Mulligan be defunding the Fed and opening Fort Knox? Well, Midas Mulligan would be a private banker, so I imagine he'd be in Gulch somewhere, in fact. Jonathan, thank you for your pledge. You're a stalwart. Dwayne, thank you for your your pledge also. You're equally stalwart, and appreciate your support and your comments. All right, let's go. Let's go on to part two. What's been in the news lately, all over the news, is that's the debt ceiling. This is in this golden age of misinformation we seem to be in. The fables surrounding this recent debate on the debt ceiling are to me the epitome of a false narrative. So there are at least three giant falsehoods that have been spread by politicians through the mainstream news. And I'm going to call them the hogwash fables. And I want to discuss each in turn. And some of the following information I'm going to give is from the Mises Institute, and some of it is from me, my own gathering of data. Okay. Hogwash fable number one. The Republicans want to control spending. They don't. When politicians talk about spending cuts, they're really talking about small reductions in the rate of increase in spending. For example, if defense spending has been increasing, say 2% per year, and then an increase the next year of 1.5% is adopted, some politician will identify that as a spending cut. Now, in reality, that's not a cut at all. It's actually an increase. It just went up by 1.5% instead of 2%. It's just less of an increase than someone else projected. It's equivalent to saying, I might have gained 20 pounds this year, but instead I gained 10 pounds. The result was I lost 10 pounds. Now, obviously, that's a dopey claim. Now, in the current debate, which is apparently over now because the House has just passed a bill, the Republicans said they wanted to spend less than last year for the 2023 fiscal year, and then put a cap on spending at 1% increases each year for the next 10 years. But under the bill passed yesterday by the Republican-led House, spending is going to continue to increase rapidly. Still, in the minds of most Washington politicians, any slowdown in the flow of free money is going to be branded a quote, a cut. So you can expect to hear that kind of rhetoric. We cut spending. Now, before anyone lays claim that this is indeed what we got was some sort of a meaningful cut, let's look at the federal outlays over the last 20 years. And this is a forecast from the Congressional Budget Office. Do you see any trend moderating spending here? Oh, by the way, the black line is a 5-year moving average. I don't. I see the opposite. And here is a record of the percentage increases in spending under Republicans and Democrat administrations. Of the top 4 increases, 3 are under Republicans: Trump, Reagan, and Ford. And Jimmy Carter is in the number 2 spot. So the fact is that neither side, Republican or Democrat, really wants to cut spending. The squabbles between the left and the right are only over non-essential symbolic issues. For example, Republicans wanted to install some token work requirements as a condition of receiving certain welfare payments. Neither side will even touch Social Security or Medicare, even though these are the programs that obviously will have to be reformed someday, but not today. Some of these Republicans remind me of St. Augustine, the famous church father of the early 5th century, who wrote about his struggle to control his illicit desires. Augustine longed to do the right thing in the church's eyes, but not just now, he said, not yet, not today. And in a similar way, these virtue signaling politicians, especially the Republicans, hope to enjoy the fruits of their spending a little longer before they repent. Let me bask in the pleasure of my fiscal sins a little while longer before I submit to the reality of fiscal responsibility. So that's hogwash fable number 1. Despite what they say, with rare exceptions, there are some, our politicians, and especially most Republicans, are not serious about controlling spending. Okay, Hogwash fable number 2. The US has never defaulted, so we can't default now. We can't default now because we never have. So this is a mainstay. This was a mainstay of the debt ceiling and budget debate. And this was the impetus for saying that you had to reach an agreement immediately because the Treasury was running out of money and the USA cannot fail to pay any of its obligations. Because after all, they say the US has never missed a payment. But that is not true. The US has definitely defaulted on its debt on at least 3 occasions. The first was the American Revolution, when the US defaulted on domestic loans. After the Constitution was adopted in 1790, the federal government renegotiated past debt that was at less favorable terms for the investors. That was default number 1. Then there was the greenback default of 1862. The original greenbacks were 60 million in demand notes, which were redeemable in gold, supposed to be redeemable in gold and silver. But less than 5 months after they were issued, in January of 1862, the US Treasury defaulted on these notes by failing to redeem them on demand. So that's default number 2. The most blatant default was the Liberty Bond default of 1934. The US was contractually obligated to pay back its debts these were war bonds from the previous war, and the US was contractually obligated to pay back its debts in gold. Franklin Roosevelt decided to default by refusing to redeem them in gold, at least to Americans, and then further devaluing the dollar by 40% against foreign exchange. So that's default number 3. Then there was a short default in 1979, as the late financial analyst Jason Zweig noted a number of years ago. He said that in April and May of 1979, there were computer malfunctions. And amidst this, heavy demand from small investors, and in the wake of congressional debate over raising the debt ceiling, the US failed to make timely payments on some 122 million in Treasury bills. That sounds like chump change today, but the Treasury characterized the problem as a delay rather than a default. But the US was promptly sued by bondholders for breach of contract. So that was probably default number 4. Then there's, of course, the ongoing soft default of inflation that pays back government debt in debased dollars. And you might even say the US government is, in fact, in a state of perpetual default. So when you hear Joe Biden or Janet Yellen or any other politician insist the US has never defaulted, now you know better. Okay. Hogwash fable number 3. Failure to reach a debt ceiling agreement would have resulted in default. Now that argument claims that a failure to raise the debt limit would result in default because the federal debt clause of the 14th Amendment means all government bills must be paid in full on time, and there's no ability to prioritize or delay some payments over others. In other words, this argument claimed Treasury is not permitted by law to prioritize payments using only available funds. But we know that if there had been no deal at all, the Treasury could have and would have prioritized its payments using available funds. And we know this based on the words of the paymaster herself, Janet Yellen. We take the debt ceiling seriously as a constraint. My assumption is if the debt ceiling isn't raised, there will be hard choices to make about what bills go unpaid. Obviously, some would go paid. We have to pay interest and principal on outstanding debt. Okay, that's a priority. We also have obligations to seniors who count on Social Security, our military that expects pay, contractors, and so forth. I would say we're focused on raising the debt ceiling, and there will be hard choices if that doesn't occur. And by the way, there was enough revenue, always enough revenue, just from tax receipts, to pay interest on the debt plus Social Security and Medicare. And in her own words, Janet Yellen would have started to make the hard choices by paying some bills and not others. So even if there had been no deal at all, the Treasury would prioritize payments to keep the government going. And I would say Republicans if they were serious, they missed their chance to use this as leverage, because things would not have shut down. All right, this entire this entire debt ceiling debate, in my view, was a farce. The closest analog I can think of to it is kabuki theater. Kabuki, as you know, is a highly symbolic, heavily stylized a Japanese art form. Now, here are the main characteristics of kabuki theater, which I looked up on a popular website on the subject. Quote, kabuki means the art of song and dance, incorporating mime, elaborate costumes, and extravagant backdrops. Kabuki is a grandiose visual spectacle, focusing more on looks than on story. Kabuki dramas depict tales derived from historical myths. I guess like the myth of the balanced budget, huh? Facts, reality, and consistency take a backseat to fantasy, elaborate costumes, and supernatural transformations. And a related Japanese verb, kabuku, means, quote, to behave oddly. So if you can think of a better analogy to the current debt farce, please let me know. The kabuki theater of debt limit debate is just a way for politicians to pretend they really do want to pay down this unpayable debt. It's a way to pretend that they are responsible stewards of government spending, but it's all theater. And to me, this latest debt ceiling performance is confirmation that we are on a long road. We're on a long road of inflation that will have to be addressed by financial repression, which, as you know, means high consumer price inflation, along with suppressed real interest rates. Now, okay, before we leave this topic, check time here. We're good. To update you on some of the seriousness, what kind of the linchpins are here. The key breaking point in the budget, I think, will likely be the amount of interest expense that the Treasury has to pay as it continues to borrow. This year, just this year, interest expense is closing in on $1 trillion per year. It's already surpassing the defense. It's already just about equal to the defense budget, or slightly surpassed, I guess, this year. But here in this chart is the projection of the nonpartisan Congressional Budget Office, which historically always underestimates the debt burden in its projections. So by their rosy scenario, 10 years from now, interest costs of $2.4 trillion will exceed, I'm sorry, I'm on the wrong chart. Interest costs of 1.4 trillion will exceed every other key spending program. Okay, but in the next 25 years, interest costs as a percentage of GDP will exceed 7%, and they'll exceed 33% as a percentage of total government spending. Now, that's equivalent to you or me spending $33,000 in annual interest charges on an annual salary of $100,000. That would mean that you had total debt that was 5 or 6 times your $100,000 salary, all on your signature with no collateral posted. Now, no responsible bank or any other honest lender would lend you that amount. And if the government pulls it off, I believe it'll only be because they control the interest rate. Simply put, the superficial debate over the debt limit really masks the real problem. Our debt is unpayable in current dollars. The problem must be resolved eventually, but there's no appetite to do it now because these reckless spending programs are so popular with the people, and the people elect the politicians who keep increasing the deficits. However, I can only partly blame the masses for clinging to these spending programs. After all, if you force feed a goose for its entire life, can you expect it to turn down the next meal you give it? No, you can't, because he's dependent on the force feeding, and he's unlikely to give up his barnyard complacency, let's put it that way. So my urgent advice to you is plan your financial affairs so that you are not like this barnyard goose, so that you are not dependent on a master who force feeds you into submission with inflated dollars. Okay, let's take a quick pause here. Robert Nasir, poor goose. Yeah, that's what I thought too. Robert says, thanks for your work. He says, this is great. He says, what do you wish you'd been taught in grade school? Economics and finance were among the popular answers. Well, I agree. Basic economics and basic finance should be a part of either basic math or basic history if they don't teach economics as a separate course. Nothing quite like paying one credit card balance with a cash advance from another card account again and again and again. However, there is a limit to that, especially, you're right, but there's a limit to that, especially if the credit card balances keep going up. All right, let's move on to final comments, part 3. Where am I here? I have the right slides. Got them a little out of order, I think. Here we go. Finally, I'd like to share a few. The title of this last section could be NVIDIA joins the $1 trillion club. I'd like to share a few comments with you about the extraordinary price action in the last few weeks in these artificial intelligence stocks. These stocks are Facebook, Amazon, Apple, Netflix, Google, Microsoft, Advanced Micro Devices, Netflix, I already said Microsoft, NVIDIA, and Tesla, also known as, by the acronym, FANG, F-A-A-N-G plus MNT, FANG plus MNT. Now, they're led by NVIDIA, which is up 167% just in 2023, just this year alone. And most of that's occurred in just the past few weeks. Back up now to, as I got my slides out of order here. Just this last week, the euphoria continued, and NVIDIA joined the big four, Apple, Microsoft, Google, and Amazon, in the $1 trillion market cap club. And notably, that's all due to lofty expectations, because NVIDIA currently only has $26 billion in sales versus at least 10 times that much for the other big four. Now, the other stocks shown on this chart, besides those four, previously, for example, Tesla, previously surpassed 1 trillion, but they're not currently, they've since pulled back. Okay, so here's a chart showing the last 12 months revenues of these very expensive companies. And you can see all of them trade on very high expectations of rapidly growing earnings. Maybe just how high are those expectations? NVIDIA trades at 38 times sales and over 200 times earnings. Just as reference for those of you who, that's unfamiliar to. As a value investor on a typical industrial company, I thought if I could buy it at 10 or 12 times earnings and it had good prospects, that was worth a look. This trades at 200 times earnings and 38 times sales. We've never before seen a price to sales ratio that high for a company this size. 26 billion in sales being valued in the stock market at over $1 trillion. The closest thing that comes to mind, comparison that comes to mind, was Tesla, which traded at nearly 30 times sales when it hit the $1 trillion stock mark, $1 trillion market cap mark back in 2021. And what happened to that? Well, it would go on to decline over 70%, with its price to sales ratio falling to 5 times. But some people say, the people who tout these stocks will say, valuations no longer matter in the age of AI. It's all about growth. Where have we heard that before? in every mania of the past, and AI is, in my opinion, just the latest example, we've heard that same thing every time. NVIDIA represents a actual paradigm shift in productivity. I think that's true. Tesla represented a paradigm shift in technology as a solution to a problem, or so-called problem, of climate change. But yet it's clear to me that the elevated stock price of both is a product of both hope and hype. I'm old enough to remember Amazon stock back in 1999. Amazon, too, was a game-changing company. And as part of the tech stock crash of the early 2000s, the price of Amazon declined by 95%. Of course, it eventually went on to become one of the most amazing companies in history, and it has rewarded its shareholders very well over the long term. But nobody knew that for sure in 1999. I also remember that in the early 2000s, the tech stock rally became very concentrated, just like this one that we're into is. I knew people at the time who had their entire 401ks piled into the so-called four horsemen. That was Microsoft, Intel, Cisco, and Dell Computer. As the broad market crashed, it wasn't crashing, it was declining. These stocks were rallying strongly until they crashed around 2002 and lost 90% of their value. All four survived as companies. They're still around. Some became great companies. Some became also Rands. The point is, you don't know until well after the fact. And the hype and mania around AI stocks today is very reminiscent of this, and it's speculative to say the least. This chart from Bianco Research illustrates how the return in the broad market, the S&P 500, is concentrated in very few stocks. These 8 AI stocks, which together are 28% of the market cap of the S&P 500, 28%, account for more than 100% of this year's S&P 500 performance. So this means that if you are invested in the index, you are really heavily invested in 8 AI stocks. So Jim Bianco, who I respect a lot, puts it this way, I'm paraphrasing. He says, the stock market can currently be broken down into 2 broad categories. One side are the AI chat GPT stocks, highlighted by the 8 mega tech, FANG plus MNT stocks. These are soaring. But beyond that, the rest of the stock market stopped cold when the banks started failing on March 8th. Now, the economy needs healthy banks, but maybe the AI stocks don't need the banks. So what is the message of the market? I'm not sure, but it does seem to be the tech is booming as it ushers in this paradigm shift in the economy. The rest of the economy is stuck in the mud ever since the banks started struggling. Now, to be clear, I am not denouncing AI at all. I think it's a paradigm shift, and I think it's going to change the world. I myself use Chat GPT, and I'm not exactly what you'd call an early adopter of technology, but it's an immense productivity tool, and I don't even think I know how to use it yet. So I urge you all to try out Chat GPT or one of the other emerging, AI apps. Just treat it like it's your personal assistant. It's not always right, but it definitely helps you think of alternatives that you otherwise would not have considered. So while NVIDIA and the other AI stocks represent a game-changing technology, the runaway stock price is most likely an all too common tale of excessive hype. So my closing message is, be careful out there. And if you are in the stock market, understand what you are invested in. Okay, we got a couple more minutes for a comment or two. Yeah, we do. Robert Nasir. Yes, you're right, Robert. Thank you for your pledge. And he comments, there's only so much you can insulate. There's only so much you can do to insulate yourself, but do all you can. That is true. Philosophical Zombie Hunter pledged $2, and he says, would reducing spending reduce inflation? Indirectly, yes, it would, because it's the spending that requires debt to federal debt to finance the spending, and it's the inflation occurs when that debt is monetized, either by banks or by the Fed, most often in big quantity by the Fed, and they buy that debt and replace it with money in a way that I've described previously, but we don't have time to go through it now. But in a number of other of these presentations, I've gone through that in detail. But so spending is, I guess you would say, it's the start of the inflation chain, but it's only if all you did was fund spending with tax money, that would not be inflationary by my definition, in that it would not raise the quantity of money in the economy, would not increase it. Okay, and so who else here? Zion Perez pledges $5. Thank you very much. You guys are great. Appreciate it. Okay, now I have one more quick announcement. I hope it's okay to say this. You can see at the bottom. Razi has asked me to do a course on modern money creation and its consequences. And if all goes well, I'll start that in July, probably mid to slightly after mid-July. And I plan to make it a one session per week for 6 weeks, a course, and it'll be held on the typical Finance Friday days. Now, the advantage of this is that you will get what I've given you over the time is my thoughts and theories, not my theories, but thoughts and theories on modern money creation as it applies to a specific issue or specific problem. That's mostly what I've done. As a result, you may not have, even if you listen to every one of these podcasts, you may not have it all in a readily usable form that you can hold as a body of knowledge. But I think in presenting it as a systematic course, I can show where money comes from, the difference between good money creation and bad money creation, examples of both, where we're headed today, where money creation is occurring today, how it will occur in the future, in my opinion, and what that is going to lead to. And the benefits of this will be, number one, you will have a better understanding of what your government is doing in their policies on money creation. And you'll be better able to anticipate their next move. Probably most important, you'll have a way of understanding what's coming at you personally, and you might be in a better position. I think you will be in a better position to anticipate the government's moves and how that can affect you financially and plan accordingly. Okay? All right. Anything else? I'll close with Edmund's statement. May all objectivists get rich. I agree. Have a great weekend, TGIF. Thank you for listening, and I will see you again soon.